Someone posted on Rye Personal Finance last week. Then again the week before. Same story. Different state. I want to read the first one. Quote, dealership called me 2 months after I drove off the lot and said my loan wasn't approved. They want me to come back in and sign at a higher rate or return the car and lose my down payment. End quote. Read that again. 2 months after he drove the car home. The post had 985 upvotes. A week later, a near-identical post from California hit over 1,000. Same structure, same confusion, same question in the comments. How is this even legal? Look, here's the thing. When the dealer hands you the keys and you drive off the lot, you think the deal is done. You signed paperwork. You made a down payment. You drove the car home. That is a deal. No, that is the setup. Let me give you the math on one of these. A $25,000 used car. You sign at 5.5% APR over 60 months. Your monthly payment is $478. You put down $4,000. Easy. Go home. 2 months later, the dealer calls. Your financing fell through. Quote, we couldn't get it funded at the rate we quoted. End quote. They have a new offer. 9.5% APR. Same 60 months. Your new monthly payment, $525. $47 more per month. Now get this. Multiply that by 60 months, $2,820 in extra interest over the life of the loan for a car you already own, for a rate change you did not agree to at purchase. That is a down payment on a different car. That is a family vacation you don't get to take. That is the emergency fund you spent 3 years building. And here is the kicker. You can't negotiate. The dealer gives you 2 choices. Sign the new rate, or return the car and eat your $4,000. There is a name for this. Inside the industry, they informally call it yo-yo financing. You drive off. They yank you back. Here is how it works under the hood. The contract you signed at the dealership was not a final loan. It was what is called a conditional sale with spot delivery. The dealer has a clause. It is in the stack of paper you signed in 12 minutes without reading, that says the financing is subject to lender approval within a certain window. Most states allow 30 to 90 days. California, Wisconsin, Massachusetts cap it at 10 to 15 days. Texas, Florida, Georgia give the dealer up to 90. During that window, your loan is not actually funded. The dealer is shopping it. If the original lender at 5.5% says no, because your credit dropped, because your debt-to-income ratio doesn't work, because anything, the dealer goes to a second-tier lender. That lender agrees at 9.5. So the dealer calls you, and you think you're getting bad news about approval. What you're actually getting is a pricing move. Here is where it gets surgical. The Truth in Lending Act, TILA, requires the dealer to disclose the APR and terms of the final loan before you sign it. But the conditional sale you signed at 2 in the afternoon is not the final loan. It is a bailment agreement, or a conditional delivery agreement, under general state contract law, usually Uniform Commercial Code Section 2-209. Governing contract modification. You know what that means? It means the entire transaction is legal. The dealer didn't lie. The lender didn't pull a bait and switch. You signed a contract that had an escape hatch for them, and they walked through it. The Federal Trade Commission has issued general guidance on spot delivery. The Consumer Financial Protection Bureau has an auto finance handbook that flags this practice. Neither agency has prohibited it, because under federal law, it is not prohibited. It is an ordinary contract modification, which means the rules are whatever the state you bought the car in says they are. In California, the dealer has 10 days. After that, the original terms lock. In Texas, they have 90, 3 months, or your loan can be recalled. 3 months of monthly payments you've been making on a loan that technically isn't yours yet. Now, here's the part that made my jaw hit the floor. You'd think the dealer loses money when your loan gets rejected. They don't. They make more. The finance and insurance desk at the dealership, the F&I office, where you sat for 40 minutes after picking the car, makes its money on commission. 2 to 3% of the loan amount, paid by the lender. Here is the twist. The rate you pay and the rate the lender offers are not the same number. Lenders buy the loan from the dealer at a lower rate. The dealer marks it up and keeps the spread. Higher APR you sign at. Higher kickback to the F&I desk. So when your original 5.5% loan falls through, the F&I manager is not sad. She is looking at a replacement loan at 9.5%. Her commission on that loan is bigger. Former F&I managers posting on RES Car Sales describe this dynamic. The first choice loan is the best case. The yo-yo loan is the actual case. And it pays better. Let that sink in. The dealer's compensation structure is directly rewarded when your loan gets denied. They are on the same side as the subprime lender, not legally, compensationally. Which, if you have quotas to hit this month, is the same thing. Okay, so why don't you just walk away? Give the car back. Refuse the new rate. Here is why. The moment you drove the car off the lot, 3 things happened. Your down payment became the dealer's. Your trade-in, if you had one, was processed into their inventory and probably sold or wholesaled. And your first monthly payment is already gone. If you walk now, you lose all of that. The down payment, $4,000 in the example, plus the equity in your old car, if it was worth more than you owed, plus the payment you already made. You're out maybe $6,000, and you have no car. The alternative, sign the higher rate. Eat $47 a month for 5 years, $2,820 total. Less than the down payment you'd lose walking away. You seeing what they're doing here? They've engineered the choice. Your rational move is to sign, because $6,000 lost today is worse than $2,800 lost slowly. The math is set up so you'd be crazy to walk, and the dealer counts on that math. Your down payment isn't a good faith gesture. It is collateral. A hostage the dealer holds for 90 days while they shop for the highest rate you'll agree to. Okay, I want to close with what to actually do. First, if you're shopping for a car right now, before you walk in, get pre-approved through your credit union or your bank. An outside pre-approval in your hand with a rate letter. Dealers can still shop their own financing, but your pre-approval locks a floor. They can only beat it, not you above it. Second, ask at the F&I desk before you sign. If this is a spot delivery, say those exact words. Spot delivery. If the answer is yes, ask the state's conditional approval window. Get the actual date the loan is considered final. Put it in writing on the contract. Third, if they call you back during the window and say your loan fell through, here is your forward line. Send me the denial, in writing, from the original lender. Because here is the thing about the calls you get from the F&I desk. Most of them are not actual loan denials. They are repricing attempts. If you ask for the written denial and the dealer can't produce one within a day, the original loan is fine. They were trying to upgrade you into a higher commission product. When the Reddit poster from April finally got hold of a lawyer, the lawyer sent one letter. The dealer backed off within 3 days. The original 5.5% loan was funded. Exactly as signed. Here is what that tells you. The yo-yo only works if you believe it. So if this video was useful, don't like or subscribe. Send this link to one person. The person you know signing for a car this weekend. You know who. Send it tonight, before they walk in. Part 2 drops next week. Extended warranties. Why the $3,000 coverage they push at the F&I desk pays out on less than 1 in 10 claims. Worse than this one. See you then?